Hello everyone, today is Friday. Fridays are usually the short day where we want to get in and get out of here. Looking forward to the weekend. It's February 4th, 2022. And I was able to go long here on a trade using the Atlas line. And this was after I had a class this morning with someone, and we were discussing something which I don't really talk about a lot, which is cycles and the types of days, and the environment that we trade in is important. We have to know if the market is in a slower environment or in a more volatile environment. And so I want to show you the trade here that I took on the Atlas line to go long. And just to give you a refresher, if the market is trading above the Atlas line, which is that dashed blue line, my goal as a trader is to look for opportunities to be a buyer. And so the Atlas line software itself provides the signals, both strength trades and pullback trades, as well as the main signals, which you see there in green, Atlas line long 44.74 and 44.74.75. So there were plenty of opportunities here to go long, as well as earlier in the morning to go short, but I couldn't trade in the morning. I just had this opportunity in the afternoon after my class was over. So here is a great opportunity to go long. It's basically on the pullback and strength trades, but I want to also focus a little bit on cycles in this video. So let me show you the trade first, and then I'll go into trading cycles and why that's important to understand as a day trader. So let me first explain to you a little bit the thought process on how the Atlas line works. When the candles in the price are trading above that dashed blue line, which is the Atlas line, I want to go long or look for long opportunities. Those S's and P's that you see on the chart are indications of strength and pullback. So I'm going to speed up this video here to save some time, but the P for pullback was an opportunity that the market pulled back and then continued back up. I want to take a trade due to that process. There's a pullback. The software provided me the signal to go long. I have a specific target, which is 2.5 points. If you look down, the ATR is indicating 2.5 points. And I also have a stop. Now, very important, I think a lot of traders fail to remember, is that your risk to your profit target can't be that upside down that it doesn't make sense. And so with the rules of the Atlas line, using either a time-based stop or a pivotal stop, I want to make sure that that relationship is in sync. Now let me show you a little bit about market cycles. All right, so what I have now is a daily chart. Today, February 4th, is the last candle, and the market's still open, so we'll see what happens here. The one thing that I'm going to explain to you is that you can't trade the same way when the market is slow in comparison to when the market is fast. We have these cycles in the market. So I'm going to add on a daily chart the ATR, the average true range, with a setting of 4, and you've probably seen the videos I have, and I use this very specific ATR to explain and understand what the environment is in any situation. So I use it for targets and stops and so on. And 107 points currently is what the market is able to do on a daily basis from high to low. Now, if you look a little bit earlier in the last few months, you can see that the cycle is the market gets slower, market increases. The market gets slower, market increases. Market gets slower and increases. Gets slower, increases. Now, if you realize the type of trades that you can take when the market is slow compared to the type of trades when the market is fast, they're different. Usually when the market is more volatile, and you can take a look at these peaks. So even if you put a line here like this, you can see every time the market reaches these peaks that this is a highly volatile situation. And what we have under that highly volatile situation is trends, and you have the market move further, and you have larger days indicated by this 107 point value where we are right now. And the same thing is true when the market is slow. So if you take a look at when the market is slow, you can see at about 30 points, 30, 25, 30 points here on a daily basis. Typically what we have instead is a lot of chop, a lot of flip-flop. So taking that into consideration, if you take a look as an example, this area, and you take a look at this area, you can see that the market is flip-flopping and chopping the type of trading that a lot of traders hate because they can't make heads or tails of it. Market goes up, market goes down. So a lot of chop and flip-flop. On the other hand, if you take a look here at when the market was more volatile at these peaks, which coincide with these peaks here, what we have instead are large range days, and that coincides with trending days. So you can see you have a large range candle here, another one, another one, another one. So if you are looking to hold on to a position, maybe you want to trail a stop for the day, maybe you're looking for larger targets, you have to know when to do it and when to get in and get out, or even maybe avoid trading under certain conditions when it's choppy. And so I use this, and this is what I was actually discussing this morning with my mentorship student. Know the right time to take a position for trending days and the type of trailing stops that you may want to do, and then also understand that you can't do that when the market is chopping around and it's slow and there's a lot of wicks, and everybody gets knocked out and stopped out because market doesn't follow through and continue. So here's a perfect example of why you should hold on and look for trending days using this formula, and when you should maybe even stay out of the market. So for example, we've had these large range days here, this one, this one, this one, and I know that they're large range days and I can expect trends because look how volatile the market is. Now, as we start going down and down and down, when you notice that the market is starting to reach about 40 points on the ATR, 30 points on the ATR, you're going to notice that there's going to be a lot of flip-flop and choppiness happening, which is, again, more difficult to trade. You may want to do channel surfing. You may want to play the support and resistance game. Every time the market hits certain support levels or resistance levels, you can bounce off of that. All that stuff works much better under these slower conditions. So use the ATR to your advantage. So I just wanted to give you a little bit of a insight on looking at cycles. Maybe this will help you in your trading. If you have any questions, feel free to email us. There's a contact us page at DayTradeToWin. We also have a new mentorship class starting up shortly in February 9th. So if you're interested, visit DayTradeToWin.com. Grab all the free goodies that we have available as well, the news indicator, the get started guide, the simulator, all that stuff that you may need as a new or more experienced trader as well, something you can learn from. Until next time, good trading. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.